The world-renowned Disney just reported Q4 numbers, and we've seen a 10% puke in the stock after hours as Wall Street digests the earnings release. And as you would expect, there are some worrying signs from this business as they missed on both earnings and revenue estimates. The main concern, however, is with their streaming business, which we will get into in just a minute. First, we have to address the questions most investors are wondering right now, and that's if we should be religiously buying this stock with its various moats and growing consumer base while it's down 50% from the 2021 highs, or if we should be looking for other value investing alternatives. Make sure to stick around to the end of the video because we'll be talking about all that and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today we will be doing an in-depth walkthrough of the financials, the top line, bottom line, balance sheet, cash flows, etc. And we'll finally conclude with an evaluation of this business using our intrinsic value calculator to identify the buying opportunities with Disney. And if you enjoy this type of content, make sure to subscribe because we post on here regularly, analyzing the various fundamentals of the different businesses that you are most interested in. And if you have any video recommendations, leave them in the comment box below. Without further ado, let's jump into the video. All right, and as always, we will start with the comments from the CEO for this quarter just to give us a little bit of context. And they start off by saying 2021 was a strong year for Disney with record results at their parks, experiences, and product segment, outstanding subscriber growth at their direct-to-consumer services by adding nearly 57 million subscriptions for the year. So now they have about 235 million active subscribers and rolling out the service internationally, but they expect their direct-to-consumer operating losses to narrow going forward, and that Disney Plus will still achieve profitability by fiscal year 2024. They're still in the process of realigning their costs and realizing the benefits of price increases for the Disney Plus and ad-supported tiers, and that will ultimately drive continued growth and generate shareholder value into the future. Okay, if we take a quick look at the revenues over the last decade or so, we can see they've been able to grow that historically year over year, especially throughout the 2019 period and into 2020, but we did see a dip in net income there where we were seeing historical growth before that as they had to shut down their parks and recreation side of the business. And now that we have the full year results, we'll talk about that. And then you can see here they compare themselves to the S&P 500 and their shareholder returns have definitely outperformed the broad market. So again, why are we down 50% from those highs back in 2021? Well, we have to take a deeper look and look into their segment revenues. All right, and just briefly, we'll look at this from a quarterly perspective. We saw a 3% decrease in revenues for their Disney media and entertainment distribution. Then parks and experiences had a 36% increase. Ultimately, revenues were up 9%, of course, from that benefit to their Disney parks and experiences. But when we look at this from an operating income perspective, down 91% on their streaming and entertainment segment. But again, to offset the losses, they had more than a double on their Disney parks and experiences operating income. So relatively flat year over year from a quarterly perspective, at least. Now let's look at this from a year ended perspective. An 8% increase year over year when it comes to their streaming business. Disney parks and experiences, 73% increase. Again, lots of lockdowns back in 2021, severely impacting this business. And so we're seeing that return to normalcy here with $28 billion in revenues. Ultimately makes up about 24% growth year over year in total revenues. Okay, let's look at this from an operating perspective. Down 42% again from their entertainment segment. So further losses there, although they're still able to come out with positive operating income of 4.2 billion. And then again, what's holding up this 56% increase year over year is this insane increase from $471 million last year to $7.9 billion in operating income for their Disney parks and experiences. Yeah, we've definitely seen a switch with this business where during the lockdowns and such, the streaming business was definitely holding up this business. Now it's the opposite where the parks and experiences segment is definitely holding up this business. So almost a 180 there. And so that leaves us with about $12.1 billion in operating income. And so ultimately, while we had an 8% increase in revenues from their streaming segments, they had a 42% decline when it got down to operating income. And that's because it's cost them more to produce the content and host their entertainment distribution business, despite having all that subscriber growth. All right, and when we break down the Disney media and entertainment distribution segment, we can really see what actually happened throughout this year. It's that they had a 20% increase on that side of the business. But then when it comes to their cost, that severely was increased from $1.7 billion in losses last year now to $4 billion in losses. Probably what I would say is the main contributor to this 10% decline in the stock price after hours. But again, they're hoping that by fiscal year 2024, so another couple years from now, that they'll be able to produce operating profits here when it comes to their streaming segment, which of course will impact fundamentals positively if they are able to achieve that. Again, subscriber growth is definitely not the issue here. We can see across the board have increased that on a year-over-year basis, it's when we get down to their average monthly revenues per user, these have actually been declining. And they say that's because they're offering more packages, but as long as subscribers are growing, the decreases in the costs are actually going to help them in the long run. Again, it's just really getting them to that profitability standpoint. Ultimately, that leads us to our statement of income, where from a full year perspective, we have $82 billion, up about $15 billion from last year. And then we have cost to produce that revenues now up about $12 billion to $75.9 billion. And then when we deduct for our other operating expenses, we're left with $5.2 billion in operating income for the year of 2022. Now, last year, that was only at $2.5 billion. So they've more than doubled. So definitely something that investors will be happy about. And what investors are going to want to see going forward is that they can continue to improve their margins and increase the bottom line altogether. Again, getting back to that profitability in their streaming business by 2024. Now, let's take a quick look at their balance sheet. $11.6 billion in cash with about $48 billion in debt. That's definitely a cause for concern for most businesses. However, when it comes to a business like Disney, they have parks, resorts, and other property that accounts for about $67 billion alone. And they're building more, as you can see, with, about $35 billion in content. Yeah, they have a lot of assets on this balance sheet, $203 billion worth. So it shouldn't worry investors too badly here. And finally, that brings us to our statement of cash flows. We have cash provided from operating the business of $6 billion, a positive $436 million increase from last year. Deduct our capital expenditures of $5 billion. So they're spending quite a bit. And we're left with free cash flows for this year of $1 billion, down about $1 billion actually from last year. And again, it's because they've increased their spending here. But what do they do with those cash flows? Well, they're actually just focused on paying down some of that debt that they do have on that balance sheet, which is definitely not something I would complain about. But with that being said, it's time for us to get into our calculator. Just before we do that, it's important for us to project on the future of this business. And the easiest way to do that, I find, is to look at their historical results and look at where they're trying to position this business, okay? And if we look at operating income, we can see before the pandemic and before we had all these lockdowns, etc., they were able to produce about let's call it $15 billion in operating income. And that number was actually growing. For this year, they were able to produce about $5 billion in operating income. So if we plug that $5 billion figure into our calculator, and if we require a 10% return, they do not currently pay a dividend as that was cut. And if we expect that for the first 5 years, this business can grow at, let's just call it about 8%. But then as Disney Plus becomes more profitable in and around 2024, and we actually see growth in their profitability, let's say that can grow from 13% for the 5 to 10 years after that initial period on a 45 PE as they're currently kind of trading at. Yeah, the stock should be worth about $125 right now. Again, they're trading at 99, but that is not accounting for the 10% decrease after hours. They're about $89, $90 per share right now. Now, in the very best case scenario where they achieve profitability in their streaming segments before 2024, and we see massive growth, they don't just achieve profitability by 2024. They're able to positively impact the fundamentals. We see more subscriber growth, etc. They take over market share from Netflix and their other competitors. If this business can grow at, let's call it 13% for the first 5 years, that increases to 15% again on a 45 PE. The stock should be worth about $170 per share. Again, we were up to $200 back in 2021, so it's definitely achievable for this business, especially if they can achieve more profitability from their streaming segments. But then we get to the worst case scenario here, where their content costs severely impact the business and their profitability. Their growth in their parks and experiences segment really starts to level out now that majority of the rebound has been accounted for. They're only able to grow at, let's just call it 3% for the first 5 years. That drops down to 0%. Again, on a 40 PE, yeah, the stock will be worth about $53 per share. But this would be our margin of safety price. And again, that is only $30 off. And let me remind you, it is the very, very worst case scenario here. It'd be really hard to see such a wonderful business trading at a price below $50 per share. But overall, that is the analysis for Disney. What do you think the future holds for this business? Are we going to see a nice rebound in the stock price from these levels down here with growth to their different segments in their business? Or is the competition and the digital content costs going to cost them too much to really scale the business? Let me know your thoughts in the comment box below. That's all for my analysis. If you've enjoyed it to this point, like, subscribe, and I'll catch you on the next one.